Today in our preparation for the Series 6 exam, we are covering Internal Revenue Code Section 1035, which deals with tax-free exchanges of insurance and annuity products. This is a critical topic because it's a rule-based concept that exam writers love to test. A 1035 exchange allows a policy owner to move from one insurance product to another without having to pay taxes on the gains that have built up inside the original contract. This is a powerful tool for clients who might have an old policy with high fees or poor performance and want to switch to a better one. Without this provision, switching would mean surrendering the old policy, which is a taxable event. Any gain over the original investment or cost basis would be taxed as ordinary income. The 1035 exchange defers that tax consequence. The core of what you need to know for the exam is which exchanges are allowed and which are not. The rules are designed to prevent taxpayers from moving from a less tax-advantaged product to a more tax-advantaged one. You are allowed to exchange a life insurance policy for another life insurance policy, an endowment policy, or an annuity. You can also exchange an annuity for another annuity. Think about it like moving between similar containers. The exam will present scenarios to test this. For example, a question might state that your client has a life insurance policy with a $200,000 cash value and a cost basis of $100,000. The client no longer needs the death benefit and wishes to use the funds to create retirement income. The question will ask if they can move the cash value into a variable annuity. The answer is yes. A 1035 exchange from a life insurance policy to an annuity is a permitted, tax-free transaction. The $100,000 cost basis will carry over to the new annuity contract. Now, let's focus on the most common trap and the single most important rule to memorize. You cannot, under any circumstances, perform a tax-free 1035 exchange from an annuity contract into a life insurance policy. This is the forbidden path and a favorite exam question. The reason is that life insurance death benefits are generally received by beneficiaries income tax-free, whereas the gains within an annuity passed to a beneficiary are taxable. The IRS will not allow you to convert a product with taxable gains into one where those gains could eventually be passed on, tax-free, as a death benefit. So if a client has an annuity with a large embedded gain and wants to buy a life insurance policy, they must surrender the annuity, pay the taxes on the gain, and then use the after-tax proceeds to buy the new policy. Another crucial detail for any valid exchange is that the funds must be transferred directly from the old insurance company to the new one. The client cannot receive the money personally, as this would be considered constructive receipt and would make the entire gain immediately taxable. To help you remember the most critical rule, here is a simple phrase: life is a one-way street to annuityville. You can take the road from a life insurance policy to an annuity, but you can never turn around and go from an annuity back to a life insurance policy. If you see a question on the Series 6 exam that suggests a client wants to exchange an annuity for a life insurance policy, you will know immediately that it is not a permissible 1035 exchange. Remembering this one-way street concept will help you correctly answer the most common and tricky questions on this topic.